Good afternoon, everyone. This is Brittany Button, long-term care insurance specialist for Art Jetter and Company. I want to say thank you for joining us this afternoon on this exciting presentation regarding tax benefits of long-term care insurance. Now, this can be a great opportunity to educate those you're working with, whether that's a CPA or even your own clients, on simply purchasing long-term care insurance. They could see some of that premium be tax deductible come year end. With us today is Tom Fridrich of the Advanced Markets team of Mutual of Omaha. Before we hand it off to him, though, if you do have any questions during the presentation, please feel free to write those into the chat or questions box of GoToWebinar, and we'll address those at the end. So, Tom, I'll let you get started.
Thanks, Brittany. Good afternoon, everyone. I appreciate you taking time out of your day to learn about this topic. It's a timely topic because at the end of the year, people are always talking about getting tax deductions. People are also doing last-minute planning, and so I'm sure your phones are busy. It's getting pretty close to Christmas, so I'm sure most of you are at least hoping to some degree that the phone slows down a little bit, but we're all in sales, so we definitely like to keep that phone ringing. So what I'm going to talk to you today about is kind of what Brittany said. Talk about the tax advantages of long-term care and make sure you understand those so that you can use that as another way to help you sell the idea of purchasing a long-term care policy. We know they are a good idea in terms of the benefits they provide, but let's make sure our clients understand the tax benefits, and in order for them to understand them, we've got to understand them. So let's dive in here and make sure we know all the benefits we get from these policies. Now, as we go through the presentation, I'm obviously going to be talking about taxes. Yeah, that's what we're here for. But keep in mind, it's not tax advice. I'm providing tax information. I can't provide tax advice. As you provide this information to your clients, that's really what you have to do as well, because in many states, you're not allowed to provide tax or legal advice unless you're a CPA or an attorney. So if you have a client who asks you, is this deductible? For me, you simply have to tell them, here are the rules as it relates to the tax deductibility of long-term care insurance. And if you meet these requirements, it may or may not be tax deductible for you. You have to talk to your CPA, accountant, or tax advisor. It would be nice if we could all provide the definitive answer, but it just comes down to it. We're not licensed to do that in most of the states that we operate in. So just keep that in mind. That's my little hint for you as well in terms of how to convey the messages surrounding what we're going to talk about to your clients, because we know we're going to get that question. Is it deductible for me? I get it all the time over the phone, and I can't provide that specific answer, but I can give them the information that they can apply to their own personal situation. So let's get into the presentation now, and I'm not big into getting into history. I think history is interesting. American history, world history, that's all interesting to me. The history of HIPAA is not. I'm not afraid to admit that. So why am I putting it into the presentation? Well, there are two reasons. First, I didn't originally create this presentation, so I can't say that I put it in here. But the second reason is we want to make sure that our clients know that the advantages surrounding long-term care insurance aren't new. They've been around for a while. They're well established. They don't have to worry really to any degree, as far as I'm concerned, that these benefits are going to go away. So HIPAA, so that's why we're talking about it. And HIPAA is where we got all the benefits surrounding the tax benefits of long-term care insurance. You have 7702B, that section of the tax code was added as a result of HIPAA. We got the creation of what is called qualified long-term care insurance that has certain benefit triggers. You have guaranteed renewability features and requires that the policies not duplicate Medicare provisions. So again, that's the history a little bit. HIPAA was effective in January of '97. So again, the message from these couple slides is the benefits are well-founded. They're established by HIPAA, and they're founded in the tax code itself. So it's not anything that you're interpreting. It's part of tax law. It's been there for over 20 years now, and your clients should feel good that the benefits of qualified long-term care insurance will be there and that they can take these deductions if the deductions apply. So that's why we talk HIPAA. Now let's get into the real meat of the presentation, which is the deductions. Now, we're going to talk about those and we're going to break it down between individuals and businesses because depending on who's paying for the premium depends on how it's deductible. And it really comes down to whether it's an individual paying, whether or not you're a business, or if you're an employee. And we'll start first off with individuals. Let's start with clients that you have, and maybe think about some that you're talking to currently about long-term care insurance. They haven't decided to buy yet. You want to go back and talk to them. What do you talk to them about? Yeah, you could talk to them about the great benefits. You know, the fact that it covers them for chronic illness, they can get care in home in an assisted living facility, and then moving on to where we all never want to be, which is a nursing home. They've heard that pitch before, hopefully, right? You've told them about all those benefits. So now maybe you come back and talk to them about the ability to get a tax break with their long-term care insurance premiums. So for individuals paying for it out of their pocket, they're writing a personal check. Qualified long-term care insurance premiums combined with other unreimbursed medical expenses are deductible to the extent they exceed 10% of the taxpayer's AGI, adjusted gross income. That's right on the slide there. So that means your client must itemize deductions, which means they're using Schedule A on Form 1040. Hopefully, many of you, if not all of you, are familiar with itemizing deductions. If you've never taken a close look at your tax returns, I encourage you to do so. It makes all of this so much easier to understand and it crystallizes it in your mind. Because you get to see your Form 1040, you get to see the Schedule A and see how that long-term care insurance premium is placed on there and how it carries back over to the 1040 and actually saves you money on your taxes. So I encourage you all to do that this year if you've never taken a close look at your taxes. Or use TurboTax or TaxCut. It's even better if you do it yourself because then you're entering the data and it's just the more we do things in life, that's how we learn things. We learn by doing. And that's when a lot of this stuff started to become even clearer for me is when I started doing my own taxes. And that's why I pass that along. But with individuals, getting back to the deduction, you only get to deduct up to the eligible premium. And the eligible premiums are those age-based premiums that I'm sure you're all familiar with, that the IRS tells us what those amounts are each year, and we'll look at those here in just a minute. So a couple things to consider with this deduction for individuals is, remember, one, they've got to itemize, and two, it's the eligible premium. So thinking back to the end of 2017, President Trump passed the Tax Cut and Jobs Act. It was almost 2 years ago today, I believe. It was right around December 17, 18 that this law got passed. And it was important legislation because it really changed some important statutes as it relates to how we file our taxes and how the deductions were allowed. So what it did was a couple things that increased the standard deduction for all filers. So when you increase the standard deduction that we get to take, that specifically in this law, it reduced the likelihood that individuals are going to file using itemized deductions. In fact, most people, after this law was passed, most individuals, they say upwards of 9 out of 10, will use the standard deduction. And if you're using the standard deduction, you're not itemizing. And if you're not itemizing, you're technically not getting a deduction for your long-term care insurance premiums. So keep that in mind. The Tax Cut and Jobs Act also eliminated personal exemptions for all filers, which doesn't necessarily relate to deducting your long-term care insurance premiums, but that was one of the other major changes. But the nice thing is that these tax law changes are scheduled to sunset at the end of 2025. So in January of 2026, January 1st, the old tax laws come back into play, which means the standard deduction is going to go down, personal exemptions will come back, and more people will be using their itemized deductions. For example, myself, as a result of the tax law changes in 2018, for my 2018 filing, I did use the standard deduction. For the previous 6 or 7 years, as far back as I can remember, I was itemizing. So this change affected me, and as a result of that, I wouldn't be able to deduct my long-term care insurance premiums. So that's the challenge with this deduction, just to be very honest with you, is that most clients, depending on who you're talking to, are using the standard deduction. If they're using the standard deduction, it's not deductible. The good news, the tax law changes will sunset unless something is done to prevent that at the end of 2025, and most likely many of your clients will be itemizing again. The other thing to remember, as it relates specifically to individuals, is that, which can make it kind of challenging to use this deduction, is this requirement, that you're able to deduct the long-term care insurance premiums along with other unreimbursed medical expenses to the extent they exceed 10% of your AGI. So if your clients have a lot of unreimbursed medical expenses that exceed 10% of their AGI, they either, one, don't have health insurance, which may be the case, or two, maybe aren't that healthy. And if they're not that healthy, what are the chances that they can get long-term care insurance premium? Long-term care insurance, maybe not that great. So to be quite honest, this can be a tough way to deduct long-term care insurance premiums for individuals. I'll tell you a better way here a little bit later in the presentation. Here is what I referred to earlier when I mentioned that for individuals, you only get to deduct the eligible premiums. So if you have clients, individuals that are looking to deduct that premium, they're never allowed to deduct more than $1,580 if they're between the ages of 51 and 60. Now, these numbers are adjusted for inflation annually. So technically, once each year, these numbers typically go up. So they do get to deduct more than the $1,580. For example, in 2020, for that age group, 51 to 60, it's going up to $1,630. So these are your eligible premium amounts. They're age-based, and these are the actual amounts that you get to deduct in any given year. So let's say if you are in that age 51 to 60 age range and your annual premium is $2,000, the most you can deduct is $1,580. Let's say you're in that age range and your actual premium is $1,400. Well, you don't get the $1,580, you get the $1,400. This is just the maximum that you can deduct. So let's be clear about that as well. Now, as your clients age through these brackets, they started off in the 51 to 60 age group, and now they're in the 61 to 70 age group. Obviously, they get to take that higher amount. So whether or not your client gets all of it or some of it just really depends on how healthy they are and what their premium is. So just keep that in mind. For individuals, it's you got to itemize and you get eligible premium. And if you can keep those straight, that'll help you keep the deductibility of long-term care insurance premium straight as well. The other thing that I think is really helpful as it relates to deducting long-term care insurance premiums, the way I try and phrase it so that you can remember it a little bit easier is to think about your own health insurance. Long-term care insurance is treated very similarly to health insurance. It's not exactly the same, right? Because with health insurance, there's no such thing as eligible premiums, but it's similar to it in that you get to with health insurance, right, we get to exclude it from our income or deduct it, and the benefits are tax-free, and that's how long-term care insurance works. So if you can keep that straight in your mind and pass along to clients that way, that'll help them grasp it as well, because we're all pretty used to our health insurance and how that works. We never expect to get a tax bill at the end of the year just because we got health care benefits from our health insurance. And we always get to pay our portion of the premium pre-tax if we're getting it through work, and then our employer provided portion is excluded from income. So those are great benefits for health insurance. They're great benefits for long-term care. So now let's move on to business entities and talk about the deductibility there. When we talk about business entities, and so now I want you guys to shift a little bit, think about any clients or prospects that you have that own a business. Write them down if you can, and think about them, because that'll help you, as you know, just take something from this presentation and then have a reason to call them. So let's break down our clients between self-employed and C corporations, because there's important distinctions between the two. So what do we mean by self-employed, though? Let's talk about that first. A self-employed individual are individuals who are either sole proprietors, general partners, LLC members, when not taxed as a C corp, and have net earnings from self-employment. They are also shareholders that own more than 2% in an S corporation. So that was a lot. So how do I identify these people? I just gave you a definition, and you're like, well, how does that help me? Here's how you do it. You're sitting down with a business client. You know they own a business. Let's say it's, my name's Tom Fridrich. I'm an attorney. Let's say it's Fridrich and Fridrich, because I've got a brother. We're both attorneys. Fridrich and Fridrich, attorneys at law, LLC. But all you know is it's Fridrich and Fridrich. You don't pay attention to my name that much. You just know I'm an attorney and I've got this small law practice. And so you're talking to me about long-term care insurance. How do you identify whether or not I'm self-employed? Well, you just ask me. Hey, Tom, I know it's you and your brother. You've got your law practice here. How are you organized? Now, as an attorney, I'm going to know exactly what you mean. If you have just another business owner in front of you who knows how he's organized, but maybe he's not used to hearing that question, he or she might say to you, well, what do you mean? Well, just follow up with, are you a corporation? Are you an LLC? Be specific. Now, again, as an attorney, I would tell you, well, I'm an LLC. Now, that's great. I've told you, okay, you're thinking Tom's an LLC. I've got it figured out. But then you see here on the slide, it says, here's in parentheses, when not taxed as a C corporation. So now you've got to get a little bit more specific. And I'm sorry, but you just have to do this. Now you have to say, okay, that's great, Tom. I've heard good things about LLCs. How are you taxed? You've got to ask that question. And again, I'm an attorney. I may not know where you're going with this, but I'm going to tell you, well, I'm taxed as a pass-through. I'm taxed as an S corporation. The other answer you might get is, well, I'm taxed as a partnership. With an LLC, you can be taxed as an S corp, a C corp, or a partnership. And again, that gets all very confusing to some degree when you're hearing this for the first time. But to be considered self-employed, you really are just listening for LLCs, partnerships, sole proprietorships, or S corporations. If you hear C corporation, move them over. They're completely different, and we'll talk about those in a minute. So that's how you kind of dive into this subject. The other type of business that you're going to have to really kind of dig into a little bit is if you're sitting in front of a business owner and it's XYZ Corporation, and you know that in their name, or they tell, again, you ask the business owner, how are you organized? Are you a corporation? Are you a partnership? And she tells you, well, I'm a corporation. Again, you have to ask the follow-up question. Are you an S corp or a C Corp. Most small businesses that you work with will be S corporations. I can tell you that. Most LLCs that you work with will be taxed as either an S corporation or a partnership, and those are all considered self-employed. C corporations are typically larger companies, typically. So if you're in front of a large employer, there's a better chance you're sitting in front of a C corporation, okay? So just kind of keep that in mind as well. Large companies, better chance C Corp. Small businesses, if they're an LLC or a corporation, most likely taxed as an S Corp or taxed as a pass-through. That gets you self-employment. That gives you a self-employed individual in front of you, and we'll talk about the tax benefits now of long-term care insurance. Sorry we had to do that, but it is important to get there. So premiums for self-employed individuals are deductible up to the eligible premium amount. Again, because they are treated as self-employed health insurance premium payments. That's why you get it. The actual premium, though, is deductible for any of that S corporation, LLC, taxed as an S corp, or taxed as a partnership, or a sole proprietorship. Any employees of a sole prop can be, you can deduct the actual premium. But for the owners of S corps, of LLCs, of sole proprietorships, all you get is the eligible premium. Now you might be thinking, well, that's not great because, you know, they may not be deducting all of it, but here's why it's really good. Remember how I said you have some tough hurdles to jump through with individuals, right? You've got itemized, and then it's only eligible as well, and it's got to be greater than 10% of AGI. You don't have those hurdles here. So when you're selling a long-term care insurance policy to a business owner that's self-employed, that's going to be an individual policy, right? It's for us anyways, at Mutual. It's going to be owned individually. We don't issue the policy to the company, but it's paid for with a corporate check, and that's how that works. Now, the actual owner, digging into this a little bit more, the owner of, you know, that is self-employed, that premium payment from the company, so let's say the premium annually is, let's say it's $2,000 annually. Let's say this individual is between the ages of 51 and 60. So the eligible premium for him is $1,580, just to be clear. But the actual premium is $2,000. So the company is going to cut a check to Mutual of Omaha for $2,000 for let's say it's me, my long-term care insurance policy, okay? Because remember, I've got my law firm and you're selling me long-term care insurance. So I buy that policy. It's cut from Fridrich and Fridrich, attorneys at law, and it's paid to Mutual of Omaha. On my 1040 is where I take the deduction. Now that $2,000 check is going to actually be counted as income to me because that's the way the tax laws work. So I've got to report an additional $2,000 of income, and maybe that money is taxable to me anyways because the way pass-through entities works, any money, any income that the company earns for the tax year, even if it's not technically paid out to me, it's still taxable to me. So that's a great way to find money to pay for these premiums. Sometimes with self-employed individuals is sometimes they just leave money in the company and they're taxed on it anyway. So they might as well use it to pay for the long-term care insurance. So that $2,000 is taxable income to me. On Schedule 1 of the 1040, it's an attachment to it. On Schedule 1, I think it's line 27 or 28, is where I actually take that deduction. And I can take $1,580 on there, and I enter it on line 28 or 27, $1,580, and then that carries back over to line to the 1040 and is backed out from my income, and that's how I save and deduct the eligible premium on my 1040. So my net cost is $420 for my long-term care insurance. So not a bad way to get a deduction and cover me and also family for chronic illness, because with self-employed individuals, I can also cover my spouse and dependents with a long-term care insurance premium, and they don't have to be employees of the company. They just have to be my spouse or my dependent, and I get again to deduct the eligible premium. So great way to get back in front of your business owner clients that are self-employed to talk about how they can use long-term care insurance to get a business deduction and to cover themselves down the road. So now let's talk about C corporations. That's you're self-employed. So now we're going to talk about C corporations, and they get a really good tax benefit when it comes to long-term care insurance premiums, because you get to deduct the actual premium for employees, for shareholders, which means owners of the company who are actually employees, so they actually have to be providing services to the company, not just be silent owners, right? Just, oh, I'm a 2% owner, I don't do anything there. That doesn't count. I have to be a shareholder and an employee providing services. I also, for C corporations, get to deduct actual premiums for the shareholder or the employee's spouse and dependent. So the owner's spouse, the owner's dependent, actual premium deductible. The employee's spouse, the employee's dependent, actual premium deductible. Now, we don't often see, quite honestly, where business owners are buying long-term care insurance for their employees, but it's a great way for them to get a deduction and provide a great benefit to their employees. So it's something for them to think about. But the nice thing about C corporations is they get actual premium. They're not limited to the eligible premiums that we've seen for individuals and self-employed. So if you're working with a business owner, again, how are you organized? Well, I'm a corporation. Okay. If you're a corporation, are you taxed as a C corporation or an S corporation? For corporations, they get to choose how they're taxed. They all become a corporation the same way. They file articles of incorporation with the Secretary of State, but they become an S corporation and taxed as an S corporation by filing a specific form with the IRS. And that's how that works. So most business owners are going to know whether or not they're C Corp or S Corp. You just have to dig in and ask that next question, and then you find out. Now, for employees, that benefit is really nice because, again, it really looks like health insurance here, because for the employee that gets that long-term care insurance premium paid for them, they're not including that premium that's paid for in income, just like health insurance, right? So if my company is paying for my long-term care insurance premium, I don't report it as income. The company gets a deduction for it, and my benefits are tax-free. Now, you rarely get an exclusion from income on the front end and tax-free on the back end. That shows you how important it is to the government to promote long-term care insurance. It's as important as health insurance right now. So for clients that are looking for that deduction and they own a business, it's great. They're most likely going to be willing to purchase it for themselves to get the deduction. But it's always a good idea to say, hey, are you thinking about doing this for yourself? What about your employees? Could be a great way to get additional deductions, increase employee morale, increase retention, and provide another nice benefit to employees. So those are the deduction benefits for individuals and business owners. And I hope that was clear to you. We'll have time at the end for some questions. We've also got a really good tax guide that we provide each year with the updated eligible premium numbers, and it goes through all of this information to you. And I know that it's available to you through ArtJetter. If you don't get it from them, you can contact us directly and we can send you some of those. I know we've done this presentation before, and Brittany's had those available. We're in the process of updating our tax guide. It's not quite ready yet, but it should be ready very soon. I did send an email for an update on that, but I haven't received a specific date as to when that'll be available. But just keep that in mind that all of this information is available to you in a marketing piece. So as you get further and further away from the presentation and some of it becomes cloudy, remember that you have a resource that you can refer to. So let's cover a couple more topics here, and then we'll wrap it up. So on your slide, you'll see that what I kind of talked about already, which is the benefits that come from qualified long-term care insurance policies are tax-free. Now, keep that in mind that they are tax-free to the extent that those benefits do not exceed the greater of your qualified long-term care expenses or the per diem amount, which in 2019 is $370. For next year, 2020, I believe we're up to $380. So just keep that in mind. Now, what does that mean? So for most policies that are sold, maybe not most, but for many policies, they are reimbursement. Your standalone long-term care insurance policy is reimbursement. So that means that as your clients go on claim, they're submitting receipts, and the policy will reimburse them for those qualified long-term care expenses. So they don't usually have to worry about the per diem amount because they're only getting reimbursed for out-of-pocket expenses, and those are not taxable. Now, if you have an indemnity policy, which are there are some of those out there, those types of policies allow clients to but get benefits from the policy, and those benefits are not taxable to the extent they don't exceed $370 per day. And that's roughly, I believe it's $135,100 a year. So as long as your clients don't exceed that dollar amount in the year, they're not going to be taxable benefits. And so the only time you really need to watch this carefully is with the indemnity policies. Now, you could have a non-qualified long-term care expense, but typically most policies won't reimburse for that. So just keep that in mind. There are some other strategies out there in terms of trying to find dollars to pay for long-term care insurance policies. And one of the nice benefits or ways of doing that is by looking for dollars that aren't being used today. And sometimes those dollars are found in cash value life insurance policies that have been around for many years, and they've developed, a fair amount of cash in them. Or you could have a client that has an annuity that they purchased several years ago, and while they think it's nice to have, maybe they think a long-term care insurance policy is a higher priority. Well, with the Pension Protection Act of 2006, your clients can now do a tax-free exchange from a life policy into a life or annuity policy with long-term care benefits, or from an annuity policy into a new annuity policy that includes long-term care. So that's a nice way, again, to find dollars to pay for long-term care insurance. And so when you're talking to clients and then maybe they tell you they don't know or they don't think they can afford the premium, or it'd be nice if they had a source of funds other than out of their pocket, this can be another way to look for funds to pay for. So you can even go from a life policy into a standalone long-term care policy, or an annuity into a standalone long-term care policy. Just keep in mind with that, though, that not every carrier allows that. They're not set up to do that. We are one of those carriers that cannot do it, but I do know there are carriers out there that will allow that 1035 to go into a standalone long-term care policy. Now, we've got a hybrid policy, or I shouldn't say hybrid. We've got a life policy with a long-term care rider, and we do allow a 1035 from a life policy into that life policy with the rider. That we do allow. We're just not equipped to do it into our standalone long-term care product. So search out the right carrier, and if your clients have some money that's sitting around and they want to put it into a standalone policy, you can get that done. Some products, some long-term care insurance products, come with a return of premium feature. And so sometimes clients want to know, is that return of premium taxable if I exercise that return of premium option? Or a lot of times that return of premium is upon death. You're not actually exercising it, so to speak. It's more triggered. So if your clients are paying for that policy out of pocket and not deducting that premium, then the return of premium is tax-free. If, however, your clients have excluded it from income, either because their employer paid for it or because they deducted the premium, then that return of premium is taxable. And that just kind of makes sense, right? If I paid for it with after-tax dollars, then I'm just getting my after-tax dollars back, and I shouldn't have to report it in income. If I took a deduction for it and I'm getting my money back, it's taxable income. So keep that in mind. Now, earlier I mentioned that a lot of business owners will only buy the long-term care insurance on themselves. Usually when I'm talking to producers and they're working with business owners to buy long-term care insurance, they're just buying it for themselves or their spouse. Rarely do they buy it for employees. Sometimes they do, though. And here's the nice thing that you can, the way that you can maybe sell some additional policies is tell them, hey, you do get to deduct actual premiums for employees, whether it's S corporation or C corp. Employees always get actual premiums. So I can get you a bigger deduction, and you don't have to do this for all your employees. You can just pick and choose your best employees that you want to do it for. So I understand you want to do it for you and your spouse. That makes sense to me. But think about your key employees. Are you thinking about another way you can reward them? Here's a nice benefit that not only will help keep them around, but also get you a deduction. So that's the nice thing about long-term care insurance, and another way it's different from health insurance. Because if you're trying to do this with health insurance, that's not going to fly, but you can do it with long-term care insurance. You do have to make sure that the only recipients are employee shareholders or employees, and it's established that it's set up as a fringe benefit, not a shareholder benefit only. So that's something that their attorney has to do with them, but as long as they set it up correctly, like I said, you can discriminate. So that's how you sell that employee benefit, is you introduce the idea, they tell you most likely, well, I don't want to do this for everyone, and you tell them you don't have to. And now they're starting to think about 1 or 2, 3 or 4 people that they might want to do that for. Earlier I told you I'd tell you the best way to get the deduction for the individual, and I think this is the best way to get it, is you have your clients pay for their long-term care insurance out of their HSA. Now, not everybody has an HSA, right? Because you've got to be covered by a high deductible health care plan at work. And not everybody is. And not everybody has an HSA. But to the extent they do, here's your source of funds. Because with an HSA, you can use that to pay for your long-term care insurance premiums. Now, your HSA contribution is deductible, you don't get to also deduct the long-term care insurance premium. So that's double dipping, and that's not allowed. And I know somebody was probably wondering that, but the way you're actually deducting it is you are deducting your HSA contribution. So some of your clients may have a high deductible healthcare plan at work. They may or may not be doing an HSA. If they're not, here's the reason to start doing it, because now they've got a product that they want to buy, and they can use that those HSA dollars to pay the premium. You can also use an MSA to pay for long-term care insurance premiums. You cannot, however, use an FSA or a Section 125 plan, cafeteria plan. Those are just the rules. Meaning, why is that the case? Because the tax code doesn't allow it. HSA, MSA, yes. FSA 125 plan, no. Let's talk about a couple more miscellaneous tax ideas, and then again, we'll wrap this up. Some clients are wealthy and they are looking for a way to reduce the size of their estate. If you have some wealthy clients that are looking to do that, one way that they can reduce the size of their estate and not use their annual exclusion amount or their lifetime gifting amount, which are limited. You only get so much each year that you can gift away to an individual without paying gift taxes, and you can only, and that's $15,000, right? We get an annual exclusion of $15,000 that we can gift to anyone, doesn't have to be a family member, without paying gift taxes. We also have a lifetime gift tax exemption, and that's $11.4 million. And you might be thinking, well, who uses that much up? Well, not very many people use up $11.4 million in their lifetime, but there are wealthy clients out there that are definitely trying to save that. And with the medical care gift tax exclusion, that allows anyone to pay the provider directly and not have it count as a gift. So how this works is you have a wealthy parent purchase long-term care insurance for their kids, and they pay the premium directly to Mutual. If they do that, then it's not a gift that they have to report in any way. Now, pay attention to that second bullet. You can only do eligible premium, but that's okay. That's better than nothing. Okay, so there's another angle to find tax dollars as well, or not tax dollars. I'm sorry, premium dollars. Some states also provide a deduction or a tax credit for premiums paid for long-term care insurance. Now, it's not every state, it's some states. I know New York has a credit, and there are other credits out there. And really, you can just Google it. Long-term care tax credit plus New York. Long-term care tax deduction, Nebraska, plus Nebraska, and just see what comes up. There's also a really good resource out there, the AALTCi.org. AALTCi.org has on their page, it's a little bit hard to find, but they've got a link out there, a page that gives all the states that provide deductions. But just another reason to buy long-term care insurance. Here's another great benefit for retired public safety employee retirement plans. Distributions from those plans up to $3,000 may be used to purchase long-term care insurance for their retiree, their spouse, or dependent. And it's tax-free. So they get up to $3,000 tax-free from the plan to distribute for long-term care insurance. Now, it's got to be distributed directly to the carrier, which isn't a big deal. You just have to contact the plan and make sure they pay it directly to Mutual. Excluded from income, an eligible retired public safety officer is an individual serving in a public agency in an official capacity, and it includes a cop, a firefighter, chaplain, rescue squad worker, or ambulance crew member. So if you are a former fireman, police officer, ambulance crew member, maybe you're selling. Go back to your former colleagues and talk about this benefit. Or if you know someone who is one of these individuals, go talk to them and then try and get some referrals to their colleagues. If you get in with that group, you've got a good source of business there. Also keep in mind the partnership program. Many of you are familiar with this. For tax qualified policies only that are partnership program qualified, it helps clients protect assets from Medicaid. So it's not necessarily a tax benefit, but for every dollar of long-term care benefits paid, the client can protect that amount in personal assets and still qualify for Medicaid. So nobody wants to really qualify for Medicaid, at least they shouldn't want to in my mind, but to the extent that they have to because they've used up their long-term care insurance policy and they're maybe still in a home and alive, they can say, hey, you know what, I bought a long-term care policy, it paid out $500,000 in benefits for me, I get to actually qualify for Medicaid and still have $500,000 to my name that can be passed on to my loved ones. That's a nice benefit. And so that's another thing that you should really keep in mind as another good reason for clients to buy long-term care, is that if it's partnership program qualified, they'll never have to say, I'm going to run out of money or my assets are going to be used up by a nursing home. Because one, they've got the policy to protect them, and two, the policy protects their assets even after it's exhausted. So that's a great message to send and to share with your clients, and along with all the other benefits that we talked about today. So that's all I've got for you. I'm going to open the line up to questions, right, Brittany? We're taking questions?
Well, Tom, yes, we are, but we had a quiet bunch on our hands today. I don't see any questions that have been typed in, so here's your opportunity for those of you on the call to go ahead and type those in. While we're waiting to see if any questions do come in, as Tom had mentioned, we do have the 2019 tax guide available from Mutual of Omaha. They also offer 2 consumer-approved handouts, one specifically for consumers, the other more specific to those business owners, and what those deductibility requirements are for both. Now, this can be a great opportunity to pass those along to your clients that you're working with, or any CPAs or tax advisors that you do know. These are great tools to help share and educate those that you're working with. Oh, and looks like we did have a question come in, so that worked out well, Tom.
Good.
The question is, does the payer or tax deductions have any effect on the partnership program?
No.
And really, when it boils down to the partnership program, essentially I feel it's code word for an inflation rider. Most states out there, they simply want to see an inflation rider on the policy to get that partnership qualification. So really, one does not affect the other. All right.
That's a good way to put it. I like that.
You're more than welcome to steal it from me, Tom. All right. Well, it doesn't look like we have any additional questions coming in. So again, if you think of anything later on, feel free to reach out to the long-term care team here, or if you'd simply like those handouts, I have those readily available. Tom, thank you for taking time out of your day today to present for us. We really appreciate that. And everyone else, have a good afternoon.
Thank you, everyone.